I've got a great way for you to be able to trade Forex if you're really short on time. If that sounds like you, listen up, I've got some great tips for you. Hi Forex traders, Andrew Mitchem here, and today is Friday the 17th of June, and I want to talk about an issue that so many people have. And people come to me all the time and they say, hey Andrew, look, I really want to get into trading, but I'm just too busy. I'm just short on time. I don't have time to commit to trading. I don't have time to watch the charts all day, to read and understand the news. You know, it's just too much going on in my life. I'd like to trade, but I'm just too busy, whether it's a work or family commitments, whatever it might be, just don't have the time. And there's a really, really simple solution. It's just that most people don't know that that solution is there. And the solution is this. The best way for you to trade the Forex market if you're short on time is to trade the longer time frame charts. It's quite a simple solution, but most people just don't understand or think they can do that. The problem is that most people see the longer time frame charts as something they cannot trade because the stop loss needs to be too big. And that's completely incorrect. It's actually irrelevant how big the stop loss is, because it's all relative to the size of the profit target and the size of the chart that you're trading. So I'll give you some examples. People say to me, look, I can't trade a monthly chart trade because the stop loss needs to be 200 pips or 300 pips, wherever it needs to be. And what you need to do is you need to treat that monthly chart trade exactly the same as you would if you were trading a daily chart or a 4-hour chart. It's just it has bigger stop losses and bigger profit targets. But your risk on that trade, if that trade were to get stopped out, is still the same. So rather than worrying about how many pips the stop loss is, what you need to do is calculate your position size, your lot size that you take on that trade. And then if that trade were to hit the stop loss, then you lose X% of your account, whether it's 0.5% or 1%, whatever it is that you risk on a trade. And I'll give you some examples. Just this morning, I've woken up and I've had 3 trades, 2 on monthly charts and 1 on a weekly chart, that have all hit the profit target this morning and made a tremendous amount of money and profit for myself and my account, and also for my clients. And those trades were, one was taken in March, and we're now June. It was taken in March on the monthly chart. It's just hit the full profit target this morning for 943 pips and a 3.8 to 1 reward to risk. The second trade was taken in May, and again on the monthly chart. It's only a month ago, and that's made 650 pips and a 4.2 reward to risk. And the third trade that's closed today is on the weekly charts, taken 4 weeks ago. That's made 425 pips and also a 4.2 to 1 reward to risk. So I add all that up, and just quickly here, I don't even know how many pips that is, but that's roughly 50, it's probably about 2,200 pips just as a guess, but it is completely irrelevant. What I look at is the reward to risk of those trades. So let's say I risked 1% of my account on all of those 3 trades. If all 3 went wrong, I lost 3% of my account. That's what the maximum I can lose out of all of those 3 trades. Yet all 3 were profitable, and in that same scenario with a 1% risk per trade, I've just made 12.2% on my account. Now that's an enormous account gain. And sure, you can do that with intraday charts and taking multiple positions all day and night on 4-hour charts and 1-hour charts, and you can get to that kind of figure, but there's a lot more work involved. And don't forget, the whole subject about this video and podcast is how to trade Forex if you're really short on time. So let's look at that again. That's a 12.2% account gain. I took those trades 4 weeks ago, 1 month ago on the monthly chart, and 3 months ago. But I placed the trades, I saw the trade setups, I placed the trades, I had my risk controlled, I had my stop loss in, I had my profit target in place, and I've done nothing with those trades since. Absolutely nothing. So no more work has been involved. On a weekly chart, it means you just need to look at the weekly charts just once per week. On a monthly chart, you just look once per month. You know, it really is very, very simple. It requires so little time those 3 trades would have taken me less than, say, 5 minutes to see in place. Yet I've just made, if I was risking 1% on each of those 3 trades, I've just made an incredible 12.2% on my account, and I've done nothing since. So you can see the benefit of trading those longer time frame charts. Now, sure, myself and a lot of my clients, we trade those longer time frame charts and other time frame charts such as dailies and 4 hourlies, 1 hourlies, etc. But you don't have to, and that's the point. If you are very short on time, look at longer time frame charts. They offer tremendous reward to risk ratios. The longer the time frame chart, the higher probability, the technical setup, because there's more information contained within that chart. So as an example, on a monthly chart, you've obviously got the whole month's worth of information of price action contained within that chart. Yes, it does, and it can take longer to get to your profit target, but you just have to accept that if you're going to be placing trades on those longer time frames. But also don't forget that once you place the trade, there is no more work to do. It's not like you have to do work every single day while that trade is open for a number of weeks. You have to do nothing. And so 12.2% gain, 3 trades, 5 minutes work. It kind of adds up, doesn't it? So I hope that helps. I look forward to bringing you more trading news, tips and information this time next week. This is Andrew Mitchem from the Forex Trading Coach.